China-US silver supply war, physical shortage versus paper market breakdown. What if the next financial shock doesn't start with a stock market crash, a banking failure, or a surprise interest rate decision, but with a simple question that almost no one is asking out loud? What happens when the world runs out of real silver, not on paper, not on a screen, but actual physical metal that can be delivered? Stay with me for a moment, because what you read about to hear could completely change how you look at the global financial system, and why the silent tension between China and the United States over silver is becoming one of the most important and most misunderstood supply wars of our time. Right now, most people believe silver is boring. They think it's just another commodity, something that trades up and down while everyone focuses on stocks, crypto, or real estate. But quietly, behind the scenes, silver has turned into a pressure point where physical reality is colliding with a massive paper market built on promises. And that collision is getting closer by the day. This isn't a theory. It's not clickbait. It's a slow-moving structural problem that almost guarantees a breakdown somewhere down the line. Before we go deeper, if you value calm, long-form analysis like this that connects the dots most channels ignore, take 1 second to like this video and subscribe. It helps support the Silver Collapse Report and make sure these conversations reach people before the story breaks in real time. To understand what's happening today, you have to understand how different the silver market is from what most people imagine. Silver is not just an investment metal, it's an industrial metal first. It's used in electronics, solar panels, medical equipment, military hardware, electric vehicles, batteries, data centers, and countless technologies that modern life simply cannot function without. Unlike gold, most silver is consumed. It's used, scattered, and often never recovered. That alone already makes silver fragile from a supply perspective. Now add one more critical detail. For decades, the silver market has been dominated not by physical buyers, but by paper contracts. Futures, options, ETFs, unallocated accounts, and derivatives that represent claims on silver, not actual metal sitting in a vault. For every ounce of physical silver that exists, there are dozens, and in some estimates hundreds, of paper claims layered on top of it. This system works only as long as most participants never ask for delivery. That brings us to the heart of today's BSS story. The growing divide between the physical silver market and the paper silver market, and how China and the United States are positioned on opposite sides of that divide. The United States sits at the center of the paper-silver system. Futures exchanges, bullion banks, ETFs, and financial institutions that make markets, hedge risk, and manage price discovery largely operate through US-based structures. Prices are set on screens, contracts are rolled over, cash settlement is routine. The system is efficient, fast, and extremely leveraged. But it is also fragile because it assumes metal will rarely be demanded all at once. China, on the other hand, plays a very different game. China thinks in terms of physical supply chains, long-term resource security, and strategic stockpiles. When China buys commodities, it often buys them quietly, steadily, and with the intention of controlling real-world flows rather than financial exposure. Silver fits perfectly into this strategy because it intersects energy, technology, manufacturing, and national security. Over the past decade, China has expanded domestic silver mining, increased imports, built refining capacity, and encouraged physical accumulation through state-linked entities and private channels. At the same time, China has positioned itself to be less dependent on Western commodity exchanges for price signals and delivery. This doesn't happen overnight. It happens slowly enough that most people never notice until the leverage breaks. Here's where things start to get interesting. While the paper market shows plenty of silver available, the physical market has been telling a very different story. Premiums rise, delivery times stretch, inventories move in strange patterns, large withdrawals from vaults happen quietly. When physical demand increases even slightly, the system reacts disproportionately. That is not a sign of abundance, that is a sign of tightness. The real tension comes from the fact that the paper price of silver no longer reflects the difficulty of sourcing physical metal at scale. In normal markets, price is the mechanism that balances supply and demand. But when price is suppressed or managed through leveraged paper trading, that signal becomes distorted. Producers underinvest, consumers keep buying. And eventually, physical inventory becomes the shock absorber. China understands this dynamic very well. If you want to pressure a paper-based system, you don't attack it directly. You steadily remove the physical foundation it rests on. Every ounce taken off the open market is one less ounce available for delivery later. Over time, the gap between paper promises and physical reality grows wider. The United States, meanwhile, is caught in a dilemma of its own making. Silver is critical to renewable energy goals, defense systems, grid expansion, and advanced manufacturing. Solar demand alone has exploded, and each panel requires silver. Electric vehicles require silver. Data centers require silver. As policy pushes toward electrification and digital infrastructure, silver demand is structurally rising, not falling. Yet domestic mining has not kept up in a meaningful way. Environmental restrictions, long permitting timelines, and lack of investment all slow supply growth. At the same time, strategic stockpiles that once existed no longer play the role they used to. That means the U.S. is increasingly dependent on global supply chains at the exact moment those supply chains are becoming more competitive and politicized. This is where the idea of a silver supply war becomes less dramatic and more practical. It is not a war of speeches or sanctions. It is a war of procurement, contracts, refining capacity, and vault withdrawals. Whoever controls physical silver controls leverage over industries that cannot simply switch to substitutes. Now let's talk about what happens when the paper market starts to feel that pressure. Futures exchanges operate on margin and confidence. As long as participants believe delivery is possible, even if unlikely, the system functions. But if too many participants decide they want metal instead of cash, the math stops working. This is why delivery ratios matter. This is why registered inventory levels matter. This is why sudden rule changes, position limits, and settlement incentives quietly appear during periods of stress. These are not signs of health. They are signs of a system trying to preserve stability without allowing a true price reset. A breakdown does not have to look like a dramatic default. It can start with delays, then higher premiums, then incentives for cash settlement, then changes in contract terms. Each step pushes participants further away from physical ownership and closer to trusting paper promises again. But every time this happens, trust erodes a little more. China does not need silver prices to explode tomorrow for this strategy to work. It only needs the West to continue believing that paper silver is the same as physical silver. Over time, the imbalance does the work on its own. For investors and everyday people watching from the outside, this creates a strange disconnect. The price you see on a screen may suggest calm, while the physical market whispers a very different message. Those who rely solely on paper exposure may wake up one day to discover that liquidity disappeared when it mattered most. This is why silver has always been such an uncomfortable metal for the financial system. It straddles two worlds. It is money and it is material. It is an asset and a necessity. And when stress hits, it refuses to behave neatly. As this tension grows between China and the United States, silver becomes less of a trade and more of a strategic resource. In that environment, hoarding makes sense. Long-term contracts make sense. Quiet accumulation makes sense. Public debates and flashy announcements do not. What makes this especially dangerous is how invisible it remains to the average person. Most people will not pay attention until there is a headline, until a shortage is acknowledged, or until prices move suddenly and violently. By then, the underlying decisions have already been made. Here on the Silver Collapse Report, the goal is not to predict exact dates or prices. The goal is to understand structure, incentives, and pressure points. And the structure of the silver market today is under more strain than at any point in modern history. The real risk is not that silver disappears. The risk is that access disappears at the price people expect. And when that happens, paper claims are exposed for what they are, agreements that depend entirely on trust and timing. If this story resonates with you, if you see the same patterns forming across energy currencies and commodities, let me know in the comments what you think happens first. A physical shortage that forces price higher, or a paper market adjustment that changes the rules. Your perspective helps shape future episodes. And if you found this analysis useful, share this video with someone who still believes markets always tell the truth. These are the conversations that matter most before the headlines arrive. Because when the silver supply war finally becomes obvious, it won't look like a war at all. It will look like confusion, delays, and a sudden realization that the metal everyone ignored was quietly holding the system together all along.